Welcome back, dear students. We're ready now to take a look at our overview of the investment universe. We're going to take a look at the major investment alternatives and see how they dovetail with what we learned in the previous presentation about various attributes such as liquidity and time horizon and the like. So we're looking at the investment universe from afar. We're going to dig deep into the details eventually, don't worry. But all you have to concentrate on, all you have to know, all you have to learn and internalize is what is in this presentation. Cool? Don't worry about all the buzzwords and jargon. Yeah, we'll get into them eventually. Starting on slide 15. Measuring investment return is actually fairly easy. How much did you start with? How much did you end with? How long did it take you? There are two measurements. The total dollar return, which is the return on investment measured in the dollars that you received from all inflows, cash inflows, and capital gains or capital losses. But those are not as important as it is to watch what's going on with the total percent return. The percent return is the return on investment measured as a percentage that accounts for all cash flows and capital gains or losses. Because the total dollar return could be very large, but the percentage could be actually very small. It depends on what you start with. So measures of return, specifically percent return, allow us to compare investment alternatives so that we know, yeah, if we go with this guy, we're probably going to do this over the long term. This one, not so much. Yeah. Now, who's always, right? Who's always in the background? You can't talk about return, reward, without talking about risk. Slide 16. Risk is difficult to measure. In fact, it's impossible to measure, right? You can't know what's going to happen in the future. We can, based on history, give a probability that such and such is going to happen, but we don't know. All of the measures of risk are imperfect, and we'll learn some of them later on, much later in the semester. But we're going to look at the most popular one, and that's standard deviation. Don't drop the class. It's not math. Don't worry about it, folks. I know it's a terrible thing, mathematics, but really, it's a measure of the volatility of an investment. Because we really don't know what's going to happen, but we do know that some investments are going to be more volatile than others. Now, what does volatility mean in our world? It's a euphemism for, hey, I lost a lot of money. In any given year, there's about a 2/3 chance that the return of an investment will be within one standard deviation of the historical average return, plus or minus one standard deviation. So I know it sounds like math, but just realize that all it's saying is, look, we got a 2/3 chance that it's going to be between this number and this number. We got a 95% chance it's going to be between here and here. We got a 99%. Yeah, we don't know what it's going to be. And what we find is the higher the standard deviation, the more volatile the investment, the greater the variance from the norm. And in the next presentation, we will dig deeply into standard deviation and show how the volatility, the variance, the deviation can actually work in our advantage if we don't panic. So let's take a look now at the major investment alternatives on slide 17. Equities. It's a fancy word for stocks, which are actually common stocks. What a dumb name that is. I wish they wouldn't use equities or stocks. I wish they'd say businesses. Well, really, they're corporations and they're legal entities, and we're not going to get into business law, and you're not aspiring lawyers. Maybe you are, but yeah, you're investing in a business and you're part owner. On the other hand, many people say, well, that's a little risky, which, they're not lying. I'd much rather lend my money to corporations or state and local governments or the federal government. And those are called fixed income securities because we know, barring any catastrophe, which doesn't usually happen, we know we're going to get a certain amount of money over a certain amount of time and they'll pay back our principal. Those are bonds. And again, another unfortunate term. I don't know a better term other than mortgages, because they're kind of like mortgages. They're not exactly the same, but you can think of them like that. Now, short-term investments, sometimes called short-term instruments, usually referred to as just cash. Now, it's not cash, but it might as well be. These are things that we put our money in when we know we're going to need the money soon. The investments for the masses are called mutual funds, and we're going to spend all of chapter 2 weeks on mutual funds because they're so very important. The legal term is investment company. Now, I wish we would use that. I wish that were the popular term, but you're not going to hear investment company unless you work in the industry because that says what it is. Whereas a mutual fund, I understand, lots of people are putting their money together, okay. And we're going to find that chances are you're going to be investing in a mutual fund through your employer's sponsored plan if you actually go out and get a job. And then those are the big four. Those four, and we'll spend most of our time on these four. We'll spend a little bit of time on what are called hybrid securities. And they really are hybrids. They have one foot in one world, and the other foot in the other world. Two major examples are preferred stocks and convertible securities. For the vast majority of us, no, they're just not that important. In fact, there's a reason why we really don't want preferred stocks. Corporations like to buy preferred stock of other corporations, but we individual investors, not so much. The others, real estate, physical assets, especially real estate, it's a bona fide, which is a fancy word for, it's a real investment. It's an important investment. But for the vast majority of us, no, it's just not, especially if you live in Southern California or one of the back east cities where the prices are just through the roof. And then Beanie Babies and art and collectibles and gold and diamonds, forget it. They're not really good investments. I know some of you can't wait to hear about gold, but relax, we'll discuss why gold is really not that great an investment, unless you believe the world is going to end. And then the last category here are called derivatives. Options, contracts, futures contracts, they're really not investments, but they're important for you to know, if only to know you're going to stay away from them. So let's take a look now at each one in a little bit of detail. And this is all you need to know for chapter 1 over the next several slides. Equity securities. Equities, common stocks are just called stocks. They represent ownership in a corporation. You buy one share of FedEx or UPS. And when that UPS truck drives down the road, you can look at that truck and say, look at the one lug nut on the left front tire. That's my little piece of you. Yeah, these are big corporations, multinationals. And investors receive optional dividends, which are payments to shareholders from earnings, and optional capital gains, maybe even capital losses. So you notice these are exactly, stocks are risky. And one thing we don't discuss often, and you would learn this in a business law class and an introduction to business class, is that when you're a shareholder in a corporation, assuming it's not a sham corporation that was set up to scam the courts and scam people, you have limited liability, which means you bought one share, $100, and then the corporation goes bankrupt, your share is going to be worthless. But they're not going to come after you and say, you owe us more money because the corporation has more debts than assets. No, they're not going to do that. In a sole proprietorship or a partnership, oh yeah, they can do that. You'd learn more about that in a business law introduction to business class. So what we say, since they are optional dividends, and option, there's no guarantee that there'll be capital gains, we say that they're moderate to high risk to even speculative risk. And as we said, volatility is a euphemism for I lost a lot of money. If you ask somebody, how's that stock you bought? Oh, it's been volatile. What is he actually saying? What is she actually saying? Well, they bought it for $11.88 and sold it for 30 cents. Do you know anybody who's bought a stock for $11.88 and sold it for 30 cents? I know someone. He's kind of goofy, teaches Introduction to Investments at Southwestern College. I've known him all my life. It was a great company, folks. It was based here in San Diego, and they were making artificial blood, and this was the late 90s, and you always hear about the blood banks are asking for more blood, and this was all going to go away because it was going to be artificial blood, and there was going to be no more, the blood banks are still asking for people to donate blood because it didn't work. Oh well, that's the risk you take when you go with a speculative stock. Now, if you go with a stock like Nestle, which we talked about in the previous, yeah, right, exactly, it's a different situation. Historically, stocks have given us the best returns over time. 8, 9, 10%. Actually, some have done better. And maybe we should say the best financial investment returns because the real estate investors are jumping up and down saying, hey, he's not talking about relax, we'll get the real estate. They should be considered a long-term investment. Now, remember, there's going to be years like 2008, and some of you were very young at the time, but maybe you remember it. And let's see the definition for 2008 of stocks. Stocks are equity investment instruments designed to lose value. And this is paraphrased from a wonderful book that you're going to want to eventually read called A Random Walk Down Wall Street by Professor Burton Malkiel. Another wonderful book is One Up on Wall Street, and there's a bibliography. We'll come back to these books often. You don't have to read it right now, but if you do, that's great. They're fun. You can check them out at the library. They're dirt cheap online if you want to have a copy. You bought a used copy, and you can even download them to your phone, okay, from the library. So check it out. The next category are what we call fixed income securities, bonds. No, not Barry Bonds or James Bond. These are, as we said, think of them like mortgages. You're lending your money. You get to play the part of the bank. But they're not to banks or individuals. They're long-term loans to corporations, corporate bonds, state and local governments, municipal bonds. Southwestern didn't hold a bake sale to build that stadium, folks. It was $90 million, something like that. We had to make loans, and we did it through the municipal bond market. And you can buy Southwestern Community College bonds, and we will pay you a certain amount of interest for a certain amount of time until the loan is paid off. And then, of course, the granddaddy of them all, the treasury bonds. Bond investors lend their money to the bond issuers, the corporation, the city, the state, the water authority, the hospital, the bridge authority, or the United States government. And the bond investors then receive interest and a promise that the loan will be repaid when due. Do most people pay their credit cards and their car loans and their mortgages? Yes, and the same thing is true for corporations and municipalities and the federal government. Sometimes there's a default, but it's very, very infrequent. So historically, bonds have been much less riskier than stocks. So right, you're going to get less reward. Less risk, less reward. Less reward, less risk. You can't get away from that, right? Do you want to eat well or do you want to sleep well? And for the vast majority of us, they are decent, intermediate term, can be good long-term investments. But you can do better with stocks, in my humble opinion. Notice that the government municipal bonds pay less than the corporate bonds, of course, right? Right. Less of a chance of the more of a chance of the corporation going bankrupt than a government or the municipal. Now, sometimes municipalities do go through bankruptcy, but it's very, very rare. Let's see the 2008 definition. Bonds are fixed rate investment instruments designed to lose value. Actually, the Treasury bonds did well in 2008. It's called flight to quality. When there's a catastrophe, a panic, people tend to send their money to Treasury bonds because they don't believe the United States government's going to go belly up. But all the other bonds did get hurt. And it's very rare when this happens. 2022, bonds went down. And you have to go back to 1994, I think it was. Yeah, right. This is rare. Now, they don't make a lot of money, but they're not going to go down very often. But they do go down every once in a while. We're going to see that it's inversely relational to the interest rates. Interest rates went up in 2022. Bond prices went down. It's at a seesaw. And don't worry, we're going to hammer this much later in the semester when we get to bonds. Slide number 20, short-term investments, cash, short-term vehicles. The idea here is that you want your money in the short term. That's why we call them short term, right? They're normally up to a year or so. Some people, I like to think a year, maybe 2 years, depending how important this money is, maybe even 3 years if it's a down payment, or maybe this is what you're going to live on for the next 2-3 years. Yes. It's usually guaranteed or pretty darn close. Very liquid. Very liquid. Many let you simply write a check or just electronically transfer it into your checking account. There's a very low risk of losing principal. It's almost negligible. Have you been paying attention? Right, because of that, very low return. 1, 2, 3, maybe 4 or 5. Actually, some are paying more right now, 4 or 5%. But for many years, it was less than 1%. If you go back to the 1980s, they were paying 6, 7, 8%. And many of us older folks were looking forward to retiring on these short-term investments. And then interest rates fell and fell and fell and fell and fell until they finally became close to zero. So there's a interview of a friend of mine who's a short-term investor, uses CDs and the like, and she's very funny, Jean. She's a good friend of ours. She knows how I teach this stuff, so I said, let me interview you. She's okay. And she goes, I'll never be rich. Well, she knows. She understands. She understands that these are going to not pay very well. It's a place to park your money. And we'll spend just one slide on the emergency fund. We hear a lot about emergency funds. So let's see the 2008 definition. Short-term investments are instruments designed to accept what remains of investors' money after they have given up on stocks and bonds. Right, yeah. Yeah, that's what happens, folks. People put their money in the stock market and then it falls 30, 40% and they freak out, move all their money into the bank or short-term investments at the worst possible time. Wait for the market to go up 60, 70%, take the money out of the short-term investments, put it back in the stock market just in time for the stock market to... Yeah, we're going to discuss this phenomenon. Don't panic. Slide 21. Here are some examples, and at the end of chapter 1, we go into detail about all these different types of short-term investments. And why is that? They maybe really should be their own chapter because they are important, but they're really, really boring and straightforward, and so we put them in chapter 1 just to get them out of the way. And know throughout the semester that if we do need this money in 6 months, 3 months, 9 months, a year, maybe 2 years, it's got to be in a short-term investment. You just don't want it. Unless you like going to Vegas, in which case I don't want to gamble with my money if I need it in the short term. Slide 22, mutual funds. Now, we're going to spend a lot of time on stocks. We're going to spend some time on bonds and short-term investments. But for the vast majority of us, in fact, I like to call mutual funds investments for the masses. The vast majority of us are going to invest through mutual funds. If only because that's what our our company has in the employer-sponsored plan that we are contributing to, or they contribute on our behalf. As we said, the legal term is investment company, which you're probably not going to hear unless you work in the industry. A company that pools investors' money, that's where the idea of mutual fund, and invests in a diversified portfolio of securities. Yeah, in other words, we want instant diversification. So we invest in a mutual fund, and with our $50, we don't buy one stock or 10 stocks, we buy 100 stocks or 100 bonds. Because the mutual fund can purchase hundreds of securities because there's thousands, millions of us investors putting in $50 a month. The second major benefit is professional money management. And we'll discuss this in detail in the next chapter because there's some people who say, those bums on Wall Street, they don't earn their money. Well, you know, some don't. But a lot do. Some do. And our job as investors in mutual funds is to seek out companies that have been around for a long time, done well in good times and bad, in my humble opinion. As we said, very, very popular form of investment. Well, yeah, it just makes sense. You want shoes, you go to a shoe company. You don't make your own shoes. You want a pizza, maybe you make your own pizza. You go to a pizza shop. You want insurance, you go to an insurance company. You want investments, you go to an investment company. Well, mutual fund, but I like the legal term. They range from very low risk, money market mutual funds, to very speculative risk. 2008 definition? Yeah, them too. Sure, you know, if you're going to invest in stocks and stocks go down, the mutual fund's going to go down. It just makes sense. And here is a graph that was done courtesy of a previous student, a former student, Ferran Capo. He's actually based in Spain, and he's a professional artist. Mine, I'll show you mine in chapter 2, which is all made of stick figures. But here are us. We are the little people. And I like the guys on the skateboard here. We give our money to the mutual fund. Notice these are professionals. You can tell they're wearing a tie and a suit here. And then there are millions of us people who are giving billions of dollars to these mutual funds. So they create these huge pools. And so with that pool of money, if it's a stock mutual fund, they buy stocks, and they don't buy 5 or 10 or 20. Which is typical for an individual investor because it's just so much time to study these darn things. They buy 100 or 200 or 500 stocks. So you see, instant diversification, excuse me, easy for me to say. Your $50 buys 25 cents of Home Depot and 50 cents of Apple and 25 cents of Nike. That's how it works. They take care of the accounting. If the mutual fund buys bonds, then they buy 100 bonds. Some corporate bonds, maybe some municipal bonds if it's a municipal bond fund, treasury bonds. And again, instant diversification. And then if they buy cash instruments, that we'll discuss at the end of this chapter, specifically corporate paper, treasury bills, some buy CDs, certificates of deposits, then it's called a money market mutual fund. But you won't hear the term money market mutual fund. You'll just hear people say money market. Okay, but it is a money market mutual fund. There are money market accounts at banks and credit unions, which are very, very similar, but there's one major distinction. They're guaranteed by the full faith and credit of the United States government, up to $250,000, where the money market mutual fund isn't. But folks, they might as well be guaranteed. We'll talk about that at the end of this chapter. Now, in this little bullet here, this little bowl, whatever the thing is, an oval here, we see just the beginnings of the mutual fund explosion of mutual funds, types of mutual funds, and that is a balance fund that invests in stocks and bonds. They call it a balance fund. And there are dozens and dozens of types of funds that we'll discuss in chapter 2. Cool? Mutual funds are investments for the masses. Now, we'll spend, again, as I said, just one short hour, one short session on hybrid investments. Preferred stock, convertible securities, they have, as we said, one foot in one world, one foot in the other world. But for the most part, folks, we are not going to be interested in these things. Preferred stock. Now, doesn't that sound like what you really want? You don't want common stocks. You want preferred stock. No, you don't. You really don't. Corporations like preferred stock. They represent ownership in corporations, but unlike common stocks, dividends are not considered optional, although legally they are. They don't have to pay the dividends. But usually preferred stock, they're saying to you, we plan on paying a dividend in perpetuity. Like that word, perpetuity means forever, right? For a long time. And it's a great word you can use. You can spit on your friends. I just bought a stock that I hope to hold in perpetuity. How about convertible securities? These are bonds or preferred stocks that can be converted into common stocks. Oh boy, doesn't that sound exciting? Like a convertible, a car with the top down and the hair blowing through the wind, or the wind blowing through your hair, or whatever. And then the thing won't go back up again and it rains. And yeah, convertibles are not the most exciting cars. Some people love them. They don't sell that many for a good reason. And the same thing is true of convertible securities. There's just not that many of them, and some people might get involved, but mostly we as individual investors are not. And this is all you need to know, other than the fact that the two major types are preferred stock and convertible securities. What you need to know is hybrid investments are designed to offer the stability of fixed income investments such as bonds, and the opportunity for capital growth of equity investment stocks. So they've got one foot in one world and one foot in the other world. And the problem is, ain't nothing free, folks. You get the advantages of both and you get the disadvantages of both. And depending on who you talk to, I remember the first time I was trying to figure this out, I worked for a gentleman who said, they're bonds. And I'm thinking, no, they're not. Preferred stock is not bonds. And he just thought of them as bonds. He didn't think of them as growth stocks, which they're not. He didn't think of them in the growth part of the world. But, it depends on who you talk to. Obviously, preferred stock is stock. It's ownership, but it's not common stock. It doesn't give us that opportunity for growth. Slide 25. Other popular investment vehicles, some of which I hope you stay away from. Real estate. Now, real estate is an entire course unto itself, folks. The only problem is it's really hard to teach real estate from a book or a class. It's more, you got to be in the industry. You got to get your knuckles bloodied and get in there. There is a way for us to invest in properties without being landlords, without coming up huge amounts of money and having huge mortgages. And those are called real estate investment trusts. They look like stocks, and we'll take a look at them later on. Precious metals, jewels, art, collectibles, tangible assets. Some people, most no. And then some individuals, once they are in the upper echelon of income, look into tax advantage investments, limited partnerships, low-income housing projects. We'll look at some or all of these, especially real estate and tangible assets, towards the end of the semester. If you have a burning desire, contact me and we'll discuss this and make an appointment, office hour, whatever. By the way, none of these were spared in 2008. I had this burned-in memory of riding my bike with a group of folks that we would ride, and they knew I taught this stuff in 2008. And this woman was a writer for the San Diego Union Tribune, the local newspaper here in San Diego. And she was saying, how come gas is so expensive? How come oil hit in the summer of 2008, $149 or $147 a barrel? And I said to her, well, do you drive? And she said, well, yeah. I said, well, it's you. She goes, what? I said, yeah, you're buying this stuff, right? Yeah, well, that's the supply and demand. I said, don't worry, within months, the price is going to plummet. She goes, how do you know? I said, because right now, as we speak, we're sitting here eating bagels on a break of a bicycle ride. There are people running around getting these old oil rigs working, but boss, it only produces 20 barrels a day. I don't care. Get it working. Do you realize we can sell this stuff for $147 a barrel? And so when that happens, right, the price is going to plummet. 8 months later, it was selling for $39 a barrel. So you got to know what you're doing, folks. And these people got clobbered. Those who bet that oil was going to go to the moon or whatever. Yeah, this is something that most of us are not going to get involved with. Slide number 26. Now, we already showed you the word derivative. These are not investments, folks. They are speculations. And in our next chapter, we're going to hammer away the idea behind what's the difference between an investment, an investor, and a speculator, a speculation or trader or whatever you want to call them. Speculative assets that derive their value from an underlying security or asset. These things are not the assets. They're not the, no, they derive their value from the other assets. In other words, they point to something else. You look at them and they say, don't look at me, go look over there. The two major categories, and there are many others, are options and futures. Well, actually, it's called options. They're called options contracts and futures contracts. And try saying that fast 3 times fast. It's not easy. Options, as we'll learn at the end of the semester, are pure gambling. If you like Vegas, you might like options. Futures, on the other hand, have very important usages in a modern economy. But not for us. Not for individual retail investors. They are gambling at even more so than options. So we hope you'll stay far away from these things. Many in the financial world, myself included, do not categorize these as investments. In fact, it was Warren Buffett who coined the phrase financial instruments of mass destruction, or instruments of mass financial destruction. This was during the time of Iraq, and weapons of mass destruction was the buzzword. The derivative speculators did not feel so all alone in 2008. Usually they're the only ones who are proud to only have lost 30%. Oh, we only lost 30% this year. Not bad. Ugh. Stay away from derivatives. But we need to understand sort of how they work, and we got to learn about them. But for now, this is all you need to know. As I've said, all you need to know about derivatives is that they derive their value from another underlying security or asset. They're very risky, and 2 major categories of these are options and futures. So, in slide 27, we see our emphases in this course. We're going to spend a lot of time on stocks where you're an owner, because stocks are where it's at. Stocks are exciting. Stocks are sexy. Stocks are risky. We'll spend a goodly amount of time on fixed income securities, bonds, because you are loaning your money to bonds. And bonds are boring. Bonds are stodgy. Bonds are reliable. Do you want to eat well, or do you want to sleep well? And then, as we said, we'll get short-term securities out of the way where your principal is safe, often guaranteed, or pretty darn close. That's when we need the money, 6 months, 9 months. And then we'll also spend some time on mutual funds, actually right after this chapter. Because why? They are very important for the vast majority of us. Investments for the masses. For the vast majority of investors, these are the most popular and most important financial investment options. Cool? Excited? I hope so. So now, in the face-to-face class, we give out these A, B, C, D cards, or little flashcards with an A, a B, or a C, and a D. Of course, you go to university, they got a lot more money. You press a little button, and it shows up on the screen, but we don't got that kind of money. So, so now we check for comprehension. You might have heard the formative evaluations, not summative evaluations. This is getting people to see if they understand what we've been burbling about for the last 34 minutes. Investment companies that pool investors' money and invest in a diversified portfolio of securities. Investors get diversification and professional money management. So, what are short-term securities, common stocks, bonds, or mutual funds? Right, these are mutual funds. Investment company is the legal term, mutual fund is the popular term. So, this is the gist, folks. This is what we want you to internalize so that if you meet somebody on the street who says, I can't understand, what are these mutual funds? This is all you have to say. You don't have to get into all the details, later on. But for now, all you have to make them understand is that they are pooling their money with other investors and they get instant diversification and professional money management. And you might want to tell them that investment company is the legal term because I think that's a much better term, but that's up to you. Slide 29. What are investments that represent ownership in a corporation? Ownership. Equity. That's another fancy word for ownership. Investors receive optional, you should have the word optional there, Payano. Optional dividends and capital gains or capital losses. Are these hybrid securities, common stocks, bonds, or short-term securities? Yeah, common stocks. And when people use the term stocks, they're 99.99% of the time talking about common stocks. If they want you to understand that they're talking about preferred stocks, they'll say preferred stocks. Yeah. Okay. Slide number 30. What are investments with very little risk and correspondingly very little return, often used as a place to park your money or for emergency fund of 3 to 6 or to 9 or more months of income? Hybrid securities, common stocks, bonds, or short-term securities? Right, these are short-term securities, often called cash, or just referred to as cash instruments, cash investment, cash. It's not really cash under your mattress, right? Low risk, low return. Yep. And then what are fixed income securities that represent loans to corporations, municipalities, state and local governments and agencies, and the federal government? Investors receive a promise to pay interest and a promise to repay the loan. Are these hybrid securities, common stocks, bonds, or short-term securities? Bonds. Bonds are fixed income investments because we know going in what our interest rate is. We know we're going to get our principal back in 99 point whatever percent of the time. Unlike stocks where we really don't know what's going to happen tomorrow. Right. So that's why bonds are far less risky than stocks, but there's still some risk involved that we'll discuss in detail later on. And then what are securities designed to offer the stability of fixed income investments with the opportunity for capital growth of equity investments? Examples include preferred stock and convertible bonds. These are hybrid securities. The advantages and disadvantages of both worlds of fixed income stability, capital growth of equity. And then finally, what are speculative securities that derive their value from an underlying asset or security? Examples include options contracts and futures contracts. Are these derivatives, hybrid securities, bonds, or short-term securities? These are derivatives. You can make a lot of money, you can lose a lot of money. Yes! Oh boy, on the internet, I just saw that this guy said I can make 100% in one day. My $100 becomes $200, and then the next day it becomes $0. And that's how they work, right? And then maybe the next day it comes back. Usually not. So, are we going to call these investments? No. These are speculations, right? Which is our fancy word in we don't use the word gambling, but that when you hear the word speculation, you know gambling. And then finally, what are reasonable long-term expectations of returns from the following investments? Now you're not going to jump up with A, B, C, D. You're just going to throw out a number there. What do you think about stocks, huh? Well, what I tell people is 8, 9, 10%, although some stocks have done a whole lot better. Some have done a whole lot worse. Bonds, 3, 6%. Actually, before 2022, they were paying a whole lot less. But now interest rates have risen. And bonds are paying what is normally considered, I think the 10-year bonds are around 4%. It's treasury bonds and corporate bonds 5, 6, 7. Some more risky corporate bonds 8%. So typical. Short-term securities 1 to 3%. Before 2022, they were paying 0.01%. Some were just saying, look, we're not making any money. You ain't making any money. You want to put our money here? Put your money here. It'll be safe, but nobody's making any money. Others said, well, we'll pay our investors 0.01% just to make them happy, but we're not making any money off of this. In fact, we're losing money off of this because we're paying our investors 0.01% just to keep them happy. That's how it worked, folks. And then when the inflation of 2022 started to rise, they knew it was going to happen after putting the economy into it, global economy into a deep sleep. They knew coming out that inflation would kick in, and it did. Economists, they don't call economics the dismal science for nothing, folks. But there's some things they do know. They don't know when. What about mutual funds? Well, it depends on the mutual fund. If it's a stock mutual fund, it should do 8, 9%, 10%. Bonds, 3, 4, 5%. Money markets, 3%. They're paying a little bit more right now. And it depends on the underlying investment. Hybrid securities, again, you really don't really know. They tend to be closer to bonds than stocks, but not always. They usually pay better than bonds. Right, they're in between. They're a hybrid, right? You don't really know. And then derivatives, it's minus something. I don't know what it is, but forget it. Just stay away from these things. They're really, really dangerous. And so you're going to go back, right? Go back over this, internalize this. There's a worksheet, a handout called Securities Types Handout that we want you to go through and internal. It's a fancy word for memorize. And if somebody calls you up at 2 o'clock in the morning, I'm not going to do that. But if somebody called you up at 2 o'clock in the morning and said, what's a mutual fund? Oh, it's an investment where people pool their money together and they get instant diversification and professional money management. And they're very popular. Yeah. That's what you should be able to say. What are stocks? Oh, they are equity. They are ownership. And they represent ownership in a corporation. And you optionally can get dividends and capital gains, but you might lose capital losses. We get 8, 9, 10%, we hope, over the long term. So, in our next presentation, when we come back, we're going to look at investment returns and risks in detail. We're going to encapsulate the entire semester in this next one presentation where we learn, do we want to eat well or do we want to sleep well? And we hope to show you that if you follow the concepts in this class and the world doesn't end, you should be able to eat reasonably well and sleep reasonably well. But they ain't no guarantees. So go back over this, study hard, bring honor and glory to Southwestern Community College. We're so proud of you. Thank you so much for being in our class. We want this to be the best class you have ever taken, and we want you to be awesome. So in our next presentation, the eternal struggle, the eternal tug of war between risk and return.